If you want to invest in the engine that drives a huge part of the Canadian economy, you're looking at XEG. This is the iShares S&P TSX Capped Energy Index ETF, and it's the go-to tool for anyone who wants to bet on a rebound in oil and gas. Instead of trying to guess which individual driller is going to strike it big, XEG lets you own the entire sector in one go. But energy is a notoriously wild ride. One week you're at all-time highs, and the next, a global supply shift sends the whole sector into a tailspin. Today we're going to look at what's actually inside the fund, compare XEG to NRGY, and see if the dividend is enough to make the volatility worth it. So without further ado, let's get right into it. So what is XEG? It's a targeted ETF that tracks the performance of the Canadian energy sector. Specifically, it holds the companies involved in oil and gas exploration, production, and integrated energy. Because it's a capped index, it has a built-in rule. No single company can make up more than 25% of the fund. This prevents one giant stocks from completely taking over your entire portfolio. The fund has been around since 2001, making it one of the most established ways to trade the Canadian energy theme. When you buy a share, you aren't looking for a safe or balanced investment. You're looking for pure commodity torque. If oil and gas prices move, XEG is usually going to be the most direct way to capture that movement in your brokerage account. When you're deciding between XEG and NRGY, it's about choosing two completely different philosophies on how to own the energy sector. While they both focus on the Canadian oil patch, the way they build their baskets leads to very different results in your portfolio. The biggest difference is how much of each company you actually own. XEG is market cap weight. This fund follows the big get bigger rule. It's incredibly top-heavy. In fact, just two companies, Canadian Natural Resources and Suncor, usually make up nearly half of the entire fund. When you buy XEG, you're essentially making a massive bet on those two giants. If they have a good day, the fund flies. And if they stumble, the rest of the 20-plus companies in the fund can't really do much to save you. NRGY is equal weighted. This fund treats every player the same, whether it's a massive multi-billion-dollar supermajor or a mid-sized producer. It gives smaller, faster-growing companies more room to breathe. They each get a similar slice of the pie, usually around 5 to 7%. However, there's something missing. There is a subtle under-the-hood difference between the types of businesses these funds hold. XEG is a pure play on the companies that actually pull oil out of the ground, producers, or refine it, which is integrated. It almost entirely ignores the midstream sector, which is the pipelines like Enbridge or TC Energy. This makes XEG much more sensitive to the daily price of a barrel of oil. NRGY, on the other hand, often includes those pipeline and infrastructure companies. And because pipelines operate more like toll booths, so they get paid for the volume they move, not the price of the product, they're much more stable. This gives NRGY a bit of a ballast that helps it hold its value better than when oil prices are dropping, even if it might lag slightly when oil is skyrocketing. And there's also a huge difference in how they handle payouts. While XEG pays quarterly, NRGY typically pays out monthly, which some income seekers prefer. Fees are another factor. For XEG MER is around 0.6% and NRGY MER is around 0.4%. While that's higher than a broad market fund like XEGT, it's standard for a specialized sector fund that requires constant rebalancing. Let's be honest, XEG is not for the faint of heart. Because it's a sector fund, you don't have the cushion of banks, tech, or utilities to save you if the energy market crashes. You're 100% exposed to the swings of global commodity prices. If there's an oil price war or a sudden drop in global demand, this fund can drop 20 to 30% faster than almost anything else on TSX. There's also concentration risk. Even with the 25% cap, the top few holdings still dominate the performance. You're essentially making a massive bet on a handful of companies. If you already own a broad Canadian index fund like VCN or XIC, you already own a lot of these energy stocks. Buying XEG on top of that is doubling down. So make sure you actually want that much extra exposure to the oil patch before you pull the trigger. Just something to think about. When you look at XEG Holdings, you'll see the biggest names in Canadian energy. We're talking about the heavy hitters like Canadian Natural Resources, GNRL, Suncor, Cenovus, and Imperial Oil. These are upstream and integrated players, meaning they're the ones that actually pull the resources out of the ground and refine them. Unlike midstream funds that focus on pipelines, for example, XEG is more sensitive to the actual price of a barrel of oil, as I mentioned earlier. That makes it a great offensive play, so when the global economy is humming and energy demand is high, those companies generate massive amounts of free cash flow, which they often use to buy back some of their shares or hike their dividend, which is really nice if that's what you're looking for. One of the biggest draws for energy investors is the XEG dividend. Because the companies inside are generating so much cash, they tend to be very generous with their shareholders. The fund pays out a quarterly dividend, and the yield typically sits in at 3 to 4% range, though it can fluctuate very wildly depending on the current stock price and the price of oil. What's interesting about the energy dividend is that they often come with special extras. Many of the companies in XEG's top holdings have started paying out bonus dividends when oil prices stay above a certain level. While the fund's base distribution is solid, your total yield can look very attractive during a bull run in the energy sector. It's a nice way to get paid while you wait for the next big move in the commodity cycle. So, should you add this energy play to your TFSA or RSP? Well, it depends on your appetite for risk. Choose XEG if you want a direct bet on Canadian oil and gas and you're looking for a high torque growth during a commodity boom, and you prefer owning the biggest, most established players in the space. Then I would say choose NRGY instead if you want a more balanced approach that gives you more weight to smaller producers and you prefer a monthly payout. Lastly, I would say stay away from these ETFs if you prefer a set-it-and-forget-it portfolio. The energy sector requires an active eye and quite the stomach to handle some pretty intense red days. So keep that in mind. Thanks for watching the video. Just a quick heads up, the video is for educational purposes only. I'm not a financial advisor, just a guy sharing my own research, my own opinions, so definitely do your own homework before you move your money around. If you found this breakdown of the Canadian energy sector helpful, hit the like button and subscribe to the channel. It helps the algorithm realize that these deep dives are actually useful to the community and they mean the world to me. Thank you. Once again, thanks for watching, and I'll see you in the next one. Take care.